Welcome back to the Capital Mindset Show, everyone. We're going to be going over a list of stocks here that have been on the list for quite some time, and they'll be separated in this longer video by chapters. But the first one we're going to be talking about today is Kohl's. So Kohl's is a retail company, well, a discount retailer of sorts. We could just say it like that. And on the preliminary look, we do have a P/E ratio about 4.45. A dividend yield about 6.92% there, and all in all, a size or market cap of $3.7 billion. So not too big, not too small. It's kind of like in that medium size for these retail companies, and we'll go over some other ones too. But for the most part, I also want to show you the actual website. You can kind of glance through this, but to kind of get an idea. For those of you who haven't heard about Kohl's, I know you would think so, but we have a very global audience, so not everyone actually knows about some of these retailers. But here you go. So with this being said, we're going to kind of go over some of the financials that we are going to find here on their different reports. I think we're going to go over the quarterly report here is to get the most up-to-date picture, and we're going to go off of the most recent one right here on the balance sheet. We can see in terms of assets, they have a decent amount of cash, about $646 million. Remember that the market cap, just to remind ourselves, let's go to the stock here, about $3.71 billion. So let's get that scale in terms of the back of our minds. Cash is actually declining, so we can kind of say, okay, well, what's going on? Could be that inventory problems that we've been identifying with a bunch of other retailers. Could be that we do see that merchandise inventories is growing, so they're growing that base there. It's growing from 2021, where a lot of retailers that we've discussed all were citing problems with inventory back in 2021. So not to be too concerned there. Now, when we go over to the liability section, this is where we kind of see how much leverage is on the balance sheet when we go over to that long-term debt. Long-term debt is sitting at about $1.7 billion. Okay, so at $1.7 billion, it is a bit of a concern relative to the size of the business, especially in a low-margin business. When we look at the operations, they don't generate an absolute crazy amount of income relative to the sales that they produce. Very normal for retail. And when we look at the short-term stuff, we have accounts payable about $1.679 billion. Now, they have not enough cash to kind of hold that off. But if we look at a current total asset or total current assets versus total current liabilities, it does shape out to be okay. It's a positive on that front. But cash could be better. It has been better in the past. It is getting worse. So that's a bit of a concern. Again, for some context, well, we're going to look at another retail stock that actually has it a bit worse. But for some context, they were almost purchased. Now, the thing is, for the bidding war, or not the bidding war, but in the bidding process, the buyer actually wanted, or more like Kohl's wanted a higher price, and the buyer didn't really want that to pay that higher price. So the talks broke down, and we did see the stock kind of decline on that news. Now, if we go over to the cash flow or statement of cash flow, we do see that the company is cash flow negative right now for this quarter. If we pull out, or we take out a bird's eye view of the whole thing, we'll actually take a look at that in the 10K. But on a quarter-by-quarter basis, they are now cash flow negative, and so we got to be concerned a little bit about that. In terms of net income, they are positive, but just barely. Okay, so we want to kind of consider that as far as, and we can see is that a major source of that negative cash flows is merchandise inventories. You can kind of see there. So that's why we were highlighting it before. Now, if we pull over the annual number, we're looking right now at the annual numbers for 2020, well, ending in January 2022. So that's 2021's year, and the previous one is 2020. We can see kind of a similar story kind of playing out, but on a bigger scale, because we're looking at the annual numbers here, and cash is still on the decline. Merchandise inventory is on the rise there. Going after that long-term debt, we do see that they actually have been paying down that debt. So good on them. If I would actually pay attention, if I was interested in this stock or very interested in the stock, I'd like to see how that's been playing out over the other years. So something that the model can do for us, but something that I'd probably pay attention to. Now, on to some other parts. I want to look at the statement of cash flows, and we can kind of get from there. Here we go. The actual parts of the business to see if they're cash flow positive, and if that's a quarter-over-quarter, kind of weird. So we do see that the company is pretty positive in terms of cash flows, typically. Okay, some instances there could be more or less, but for the most part, we do see that the company is actually generating positive cash flows. So good on that. So we're going to look at another company that's more or less questionable on that front, but yeah, good on that. So if we take this portion to the evaluation process, I'll actually we're going to go ahead and put in the ticker KSS and then see what kind of pops up. We're going to allow it to wake up here. But all right, so basically what we have from this is a rather interesting strong buy forecast by analysts. Price started about $66.69, implying 129.25% upside. Now, if we go look at some of the predictions by analysts, we do see that there is an estimation or prediction of some modest growth. When I say modest, I mean we had about 10% increase in business operations, and they do expect that to decline to about 7%. So if for this, I honestly for myself want a higher margin of safety, a really high margin of safety, and I do want to actually almost counter that and try to balance it out with some estimations for declining revenue over long periods of time. So we're going to see basically the whole list of range. So on the, let's say the highest range, they continue to eke out about a 7%. And we can see that's a very optimistic approach, or a very optimistic scenario for this company. And we're going to actually talk about some of the other risks. So you can see that, for example, let's take a look at the bankruptcy risk analysis. The Altman Z-score about 2.4, and the model's own measure coming in at it doesn't know. So both of those coming in, together at the same time. It is trading at below book value and tangible book value. So for those of you who would be curious on that front, at 29.09, it does appear to be quite cheap business. And this is probably more textbook value play. And when I say textbook value, I quite literally mean that. And then revenue, we do see that estimates are actually to decline. So aggregating from another data set of different analysts, we do see that revenue is expected to decline similar to 2021 levels and not from 2022 levels. And then cash flows are also expected to rise. So as they actually recognize more positive cash flow line items, they are estimated simultaneously to decline in revenue, but rise in cash flows. So we can kind of pencil out from there that growth of about, somewhat, what would we determine for the longer period of time? All right, so if we actually, let me actually mute this so it doesn't go off on you guys anymore. Shares outstanding, though, they've been repurchasing shares for quite a long period of time, going back from the data set. And from here, I can kind of measure that they're probably going to do something similar going forward. But, let's see. I think that the company, we have to analyze its place in the marketplace. So you got to go further than these numbers. You got to actually see, okay, does Kohl's have a place as a business in the current environment? A lot of the brands that they do sell, they're going a lot of direct to consumer. That's one thing that we want to consider. What part of their business might suffer? What are the adaptations the company's making? Because they can definitely adapt and succeed. That doesn't mean that they're destined to fail. They can very much succeed in any environment. Any company can hopefully make the adaptations necessary to succeed. So from here, let's actually try to pencil out some of the growth rates. So I have it 7%, kind of like on the higher range. And in some pessimistic scenario, I want to say we have a negative 5% growth. So what I'm highlighting to you guys here is just how cheap the business is. All right, that's what I want to show you here. And yeah, undoubtedly, it's very cheap right now. One thing I want to try to see is if we can, we don't see anything crazy in terms of anomalies necessarily. So I wouldn't actually do that for this instance. But I do think that there is a high probability that we do see some sort of decline for a longer period of time. But the market might be priced in it. It might be priced in terms of what it is. If we actually go back to the price, we can see that the buy price was being negotiated originally for around, I think it was $50-ish a share. Yeah, I just wanted to highlight because this is around, according to CNBC report, between $50 to $60. That's what originally was being disclosed or talked about. So talk went through as we were discussing earlier, but So all in all, I think right now you could probably pick up this business for a really cheap price, really strong margin of safety there. The concerns are just that it doesn't accelerate in terms of decline, right? If decline is even greater than what we anticipate here, it could turn out to be a poor investment longer term. But undoubtedly, the company is cheap. This is textbook cheap stock, okay? In terms of, actually, I wanted to kind of look with you guys at some of this stuff right here, but if we go to the actual data sort or ratios, actually, let's look at the ratios. And then with the ratios, I want to actually pull up the whole 10 years. And then let's see here. Interest coverage ratio, pretty healthy. Liquidity ratios, pretty good there across the board. Solvency ratios, pretty good there across the board. And I want to see, all in all, the totality of their performance in that time period. So they've pretty much gone nowhere. But had you been buying perhaps in these lower price points, you would have done pretty well. So the business has its issues, right? Undoubtedly. But can they overcome them? Maybe. That's kind of my thoughts here. If I wanted to acquire this position in this business, I'd probably do so maybe around these prices. These prices look interesting, to say the least, on a risk-reward perspective. Of course, what I might be kind of not appreciating is the some underpinning risk that I'd have to do further research. That I would implore any viewer to say, if you're interested, do more research to see if the risks are potentially going to manifest, okay, in a meaningful way. So the market is pricing it. So will it occur? Or is the market just being overly pessimistic because the deal didn't go through? That's another reason. It could have just, rubber banded. On that, we're going to move on to the next stock, which is Bed Bath & Beyond. So Bed Bath & Beyond, similar to the previous stock, is another retail stock. And if you guys don't know about this company, if we actually go to their website right here, if I just show you guys, and they would sell, they're another kind of discount chain. No, I don't want to do 20% yet. But another discount chain, and you can see they're doing like a crazy discount right now because of the 4th of July sales, etc. You can buy anything from, bathroom stuff, kitchen stuff, etc. So with the company, you can kind of see how the performance has been over the past 5 years. This massive underperformance relative to the market over the whole period, but even throughout this period is down 84%. The pandemic happened around April 2020. It turned out to be a fantastic investment had you been a timer of sorts, and you would have made 796% selling at the top theoretically. And then we're basically right back down to those levels. So now the question is, or the question I ask to you is today, is it interesting? Now the market cap of 367 million is now a small cap stock. At one point, it was above $1 billion. At one point, it was several billions of dollars. So the company, all in all, over the entirety of its existence, has been a pretty terrible performer over that time period. So you're only up 329% since IPO or since recorded here on Google. And so, it is what it is. So let's go from here and kind of explore whether or not through the financials that this company is a bit risky. All right, so kind of just skimming through this as well, we see a lot of the same, merchandise, all the same line items because they're very comparable businesses. Where I want to highlight or just skip over to is the actual long-term debt. Long-term debt about 1.379 billion, increase from about 1.79 billion from the prior quarter and measured in February 26, 2022. Okay, so in May, they're recording, so they're increasing in terms of debt. And remember, the debt pile is now larger than the actual market cap of the business. So a bit of a concern there. So if we go over there, and that's just going to highlight from there the actual risk profile. If we go back to the model and we actually try to plug that in. So BBBY, and then we ask it to bring that forward for us. Let's actually pull this there. All right, cool. Okay, so Bed Bath & Beyond has a price target about $29.94, implying a 546.65% upside according to the price targets by analysts. Now, with Bed Bath & Beyond, I just want to show you that we're going to have to do a different kind of analysis with cash flows. And the problem with this is if we even look, let's scroll down here. So you can see that revenue is expected actually to rise slightly, but revenue has been declining since 2020. And cash flows are also expected to decline drastically. So we're going to have to perhaps kind of do our best in order to predict how this might actually pencil out over the next couple years. But this is already getting to the point where I'd say the risk, it far exceeds the reward, and it's a very difficult stock to kind of get your mind around. Now, if the company can turn things around and improve things, you do have a lot of upside here, but the risk is so great. There's a huge risk of permanent capital loss that I personally, for me, I wouldn't really be interested in involving myself. Now, shares outstanding, they have been buying back shares over long periods of time. I would have preferred them clearly in hindsight to kind of save on that capital, kind of not leverage up the balance sheet too much, because now all those share buybacks for a long-term investor would be kind of fruitless because we're at a point of where the company might actually close its doors because it took on so much leverage, and the ability for it to continue to refinance, the doors or the walls are closing in on it because, you only have so many options. You have the capital markets in form of equities. You can, issue new shares for some capital, but clearly that would be pretty expensive right now and kind of a waste of all that money. They could have just burned your money. That would have been probably better. At least it would have generated some heat. But, all in all, it's not really a company that I'd really care for at the present moment in time. I think this is another company that really got hit hard by the likes of Amazon and other companies more so than others for the types of stuff that they do sell. Okay, so this is a company, I think there was the, what's his name? Cohen something. He invested and he lost like 62 million. He lost more than half of his money, something like that, something crazy. And he's the chairman of GameStop. So he invested in this company. He's doing, great as financially as a whole, but he lost a lot of money, I guess, in this company. Paper loss. because I don't think he's sold yet, but he'd be able to write off taxes for a very long time, I'll tell you that, or a decent amount of taxes. I think he's a billionaire, so maybe it's not all that much to him. Okay, all in all, that's pretty much what covers with Bed Bath & Beyond. Risk, very high risk to say the least. I wouldn't really be of too much interest here. The next one is Lovesac. So Lovesac's another retail company, but this one focused on furniture. So the company, all in all, over the past 5 years has performed okay. Relative to the market, it's underperformed the S&P 500. So if we actually pull that up, or you can see it right there, the S&P 500 has performed about 57%, while Lovesac's performed by about 45.54. So it's underperforming the market, but the question is whether or not, going forward, will it be a good investment? If we actually look at Lovesac versus the S&P 500 over the time period of COVID, we do see that it did perform extremely well. If we actually were to compare it as such, let me click there. Okay, there we go. And it would go up, 331%. But, it's come down a lot since then. It's come down, I think, over 50% since its highs. 66.94%. So let's take a look and not waste any time on the company's actual statements or financial statements. Here they have the balance sheet right here, and we see that cash equivalents of $64 million, down from $92 million. So they are reducing in cash, merchandise inventory is going up. So it's very similar to all these other companies. Again, we're going to see a very similar, or if not the exact same line items kind of showed across the board. Now let's take a look at that debt side. So line of credit is empty, but they do have the line item listed there. So on terms of total current liabilities, we do see about $103 million in total current liabilities. Most of that's in accounts payable and accrued expenses, etc. But nothing crazy, nothing really stands out. Operating lease liabilities, that's a form of debt in a way. You can argue it, basically, if you think about it, you do have to pay those liabilities. And there was some changes in the accounting structure, or how the financial statements are going to be conducted. And this change happened, I think was it 2019 or 2020, something like that. And there's debate in the community whether or not that was the right appropriate move or not, but I think it was a good move personally. But so if we look at the totality of liabilities in terms of lease liabilities, we're seeing about 103 million, but nothing crazy. I don't really think that. So what we don't see is long-term debt. So unlike the other companies, or unlike, to be more exact, Bed Bath & Beyond, we don't see that same level of risk, where Bed Bath & Beyond has more debt than the actual market cap. And if we remember what is Lovesac's size, if we actually go here, we can see that the size of the company is about $456 million. Now, if we actually go to the statement of cash flows, because I just want to see on a quarterly basis, are they cash flow positive? They are not cash flow positive on a quarterly basis, but we can see whether or not that's going to change on an annualized basis. We do see from a quarterly basis, they are positive in terms of income or net income. I'm going to take you guys over to the annualized numbers. All right, so looking at the annualized numbers here, we have 2021 versus 2022, and let's just go over the balance sheet real quick to kind of see if anything's different in terms of an annualized basis. We don't see really anything else. We do see operating lease liabilities at $96 million, but all in all, pretty similar. So nothing's really changed over that changing time period. But net income we do see is positive throughout the whole year, and cash flows from operations is actually positive from the totality of things. And we see net cash provided by operating activities. It was negative in 2020, positive in 2021, positive in 2022. So good on that. And it's positive even after you count the investment necessary in CapEx, or, et cetera. So looking good so far, I got to say. So now we're going to evaluate how cheap it really is relative to the market. So let's actually put it in here, and we put Love, all right, Lovesac. And let's wait for it to kind of port in everything that we need. But all in all, I would probably be expecting, okay. So analysts do have a strong buy rating with a $47 price target, implying a 56.61% upside. In terms of actual projections going forward, I think that the company is more expensive than meets the eye on a cash flow basis. So on a GAAP net income, they're probably a lot higher. The growth seems to be pretty astounding, especially what analysts are projecting out into the future. Let me bring you guys over here. And cash flows are also expected to jump nicely. And if we actually kind of see what are some of the growth estimations or projections, we do see that all in all, well, we're going to go over to the ratios here and kind of do a little trick here. But let me see, free cash flow margin. Okay, so what I'm going to do here is actually just go off of what analysts estimates here, and we're going to enable this. and just say that for the next year. So if we actually assume next year's numbers, and we're going to lower it to about 15%. We're going to keep it to 15%. Oh, I got to show you guys what I'm doing. So basically, I enabled the unprofitable analysis. I said yes for 1 year and gave them the analyst measures there. So I lowered it a little bit, and maybe we can be a little bit more conservative too. But what we'll do is we'll just change the growth rates to be a bit more conservative, more aggressive. So if we actually see the projected growth rates, and they're about pretty strong for next year, it's ranging from 35, 30, and in some instances lower of 20s or mid 20s. So I'm going to actually start penciling out some different growth rates going forward for the next couple of years. But if we average it out, it comes out to about somewhere between 15% on the higher ends, 15, 20, and then on the lower ends, around 7, 8. So what we're going to basically see is the company is cheap relative to how we are projecting them to kind of grow into the future. So that's what I should show with the 7%. So if you see with the 7% here, we get a decent margin of safety. Now, one thing that I want to highlight is take a look at this. So we don't know necessarily what's going to be their capital allocation strategy. Their dilution rate actually could be the sleeping killer at the end of the day for our performance. So if they dilute a tremendous amount, we're not going to get the same expected growth that we were, previously penciling in. In terms of leverage, I'm not surprised at all that we get an almost Z-score of 3.89, and the model itself is saying it doesn't think that there's going to be a risk of bankruptcy within its own 3 years. But all in all, I think that's interesting to note in terms of its potential growth. So again, if we put that 15%, so it's not necessarily as crazy as what the some of the analysts are saying in terms of what they're projecting for the several years into the future, I'm going to put that at about 2%. And if we kind of model that out a little bit less, so about 10%, we're in there. So you can probably see that the price target by analysts of about $47.42. I don't know. I think there's actually a lot of merit there. Okay, so. Could be that's the case. If we don't see any growth going forward, it's not there. It's not at a buy. So I just want to highlight that. So I'm going to put this at the 0% bound, and then we're going to put that at a 5% bound. And well, actually, let's put the 5% here, and let's put the 2% there. I just want to actually picture what growth rate do we really need to see in order to maintain all those same level of assumptions. And we can even start some dilution. Let's actually put that in there. So if we get some dilution, we can see that we actually do have to experience a decent amount of growth, about 10%. So anywhere we're from 3 to 2% dilution rate is where we'd have to start experiencing, or we'd have to hopefully assume that we're going to get some growth around 10 and above percent to get these desired metrics. All in all, let's actually go over, again, let's come back here to the ratios. Let's ignore the noise of the 10 years and let's keep it to these years. Over in terms of the interest coverage, that's obviously taking on the liabilities or the total liabilities there. But the current ratio, cash ratio looks pretty strong there. The cash ratio used to be above 1 consistently. Now it's not, but that's not really a big deal. Gross profit margin in the DuPont analysis, pretty strong, pretty stable. Operating margins, pretty stable and improving, actually. So when I say stable, actually scratch that, not stable, improving. Net profit margin improving as well. ROA improving, ROE also improving there. ROIC is pretty good some years. Some years it's abysmal. Well, I'm actually referring to more. My brain's looking at 2022 and thinking, why is it 6.93? Why is the previous year 29? The previous years were pretty bad, but that's mainly because the cash flows were negative. So, yeah, if they maintain cash flow positivity in the future, all well and good. Now, what I want to actually start to do, and let's actually go back and change this up, because let's actually be a little bit more conservative than analysts, and let's say, like 10%. So if we see a 10% cash flow margin, and let's say they can achieve that, we're not as aggressive as analysts, but they can achieve some semblance of that for a longer period of time. If that were to be the case, then we can see the growth rates do have to be a bit more in order to get those assumptions. Let's remove the dilution rate, and let's see kind of where we'd have to be at. What is it, 12% around there? Yeah, 12% growth rate and above is what we'd have to kind of pencil out. So my summary for Lovesac is Lovesac looks pretty cheap. Again, not going to be really for me, but I can understand the thesis behind it. It's better than some of these other companies that we've been talking about in terms of retail. I think the most risky thus far that we've spoken about is Bed Bath & Beyond. The other ones, not as much. Now, we're going to talk about one other stock, kind of like a bonus stock, and that's going to be Bath & Body Works. So Bath & Body Works is a company that used to be all part of L Brands. L Brands had Victoria's Secret, Pink, Bath & Body Works. Now they're all their own separate thing. A lot of value was realized in that transaction, but if we look at Bath & Body Works, they were trading for a long time. Not really, because this used to be L Brands. Ticker symbol LB. Doesn't exist anymore. Now it's BBWI. And on a PE basis, it's trading about 5.97, dividend yield about 2.88%, market cap about $6.36 billion. So how's this company doing? Well, let's go to their website to kind of give you everyone an idea of what the heck's going on or what this company does. So if you're a female out there, you already know this company. If you're a male and you have been shopping for a female, maybe for their birthday, your mother, your girlfriend, etc., whatever, you probably know or are familiar with the products offered by this company. But, think fragrances, bath stuff, quite literally in the name, Bath and Body Works, lotions, stuff like that. And, you go in there, that they have all these samples, you can test them out. And, it's a good present that you might want to give to your lady friend. Or, I don't know if they have some guy offerings. I haven't been in there for myself. So sounds defensive. Sounds very defensive, But I guess some gents might find a use case in some of their lotional products. That's a little bit on the nose, that joke. We got to make jokes, guys. We have to make jokes. We have to keep this entertaining. We've been talking about straight retail stocks this whole video. So there's the one joke. It's a little bit of a dirty joke, yes, but it's one joke. Okay, calm down. All right, so SEC filings, let's find the latest ones. I want to find their, let's go for the 10Ks. So 10K, let's go PDF. We'll just go straight to the 10K and just see if anything's like crazy. Actually, I want to see what year this is. Oh, okay, 2022. Fine. That's fine. Things really haven't changed that much. All right, so financial statements. Let's go there. Scroll down. Let's go to the balance sheets. All right, so let's scroll in. Okay. So all in all, I see that the cash, very similar story coming down. Let's see if the inventory is the same thing going up, but it's fine. Nothing crazy. Let's go to that liability section. I'm going to be very interested in that portion. So the long-term debt sitting at about $4.85 billion, down from $6.3 billion. So I remember with L Brands had a decent amount of debt. So good to see that they have been paying that down, and they are managing that pretty well. So I would not say that their balance sheet is of risk right now. Not of risk in terms of a debt. We're just looking at debt, and none of their current liabilities are really sticking out to me in terms of something that is absolutely ridiculous. We've talked about, what was that stock? Sleep Number. Sleep Number had a lot of no long-term debt stuff, but a lot of short-term debt stuff. And we caught that, and that was on a live stream because someone was requesting it because Everything Money talks about it or something like that. But anyways, going over this company, nothing crazy to really kind of gawk at and say, oh my gosh, that's so risky. Now, going to the cash flow statement, we do see, okay, net income about 1.3. Positive net income except for 2019. I remember when they were L Brands back then. And looking at the cash flows provided by operating activities, cash flow positive all the way through. So good on them. Lots of free cash flow relative to the size of the business. If we remember, it's sitting at about what? Let's go back here. It's at a $6.3 billion market cap. So $6.3 billion, decent amount of cash flow relative to that size. And let's actually pull this in. So BBWI. So BBWI, a little bit funny ticker if you just remove one word. But yeah. And the other one's actually, I think BBW is actually Build-A-Bear Workshop. So all in all, with this company too, I would expect some similar growth rates in terms of what is expected. Let's go down to see what analysts are kind of expecting. So cash flows to rise, sales to kind of come down, but rising from 2022. The reason why that probably changed is actually because it's a standalone company relative to the rest of the brands under the L Brands branch. So the company's actually was the fast growing part of L Brands, Bath and Body Works. Ugh, I can't speak. Bath and Body Works. That was the growing part of L Brands. And I remember back in the day when people were, talking about the company, that was the case. Shares outstanding kind of remained flat, a little bit down over the longer time period. So if we're looking at this company, I'm just going to say, okay, fine. Like let's give them the benefit of the doubt. They can do like 4% or 0.4%, sorry. And they do something like that. All right. Well, we would have to expect some growth rates of about between 5 and 12%. Let's pencil out what exactly that would be. 8, no, let's do 10. All right, 10's a little on the high, 9. So around 9%, 8%, between 8 and 9% is where we'd have to kind of pencil that out in order to get what we really desire from this company. Okay, and all in all, I want to actually then say that there are some interesting tidbits. If I were to actually go off of what analysts were to say, and let me remove this and say no, I basically removed the previous analysis that we were doing with, what was it? What was the previous company we just did? But Lovesac, that's right. So I just removed that input from Lovesac, and we kind of see how When we just go off of the current numbers, we're pretty much just fine. The company doesn't have to grow too much for us to kind of realize a positive return. Now, analysts do have a price target about $60.39, implying 117.39% upside. Now, the risk with all of these companies, I want to say, is that in retail, there is... I don't want everyone to think that retail should be trading at a high multiple. In fact, retail brands have been, for at least the past decade, looked or appeared cheap, unless they're part of the luxury category. So, think of an LVMH. LVMH is, Louis Vuitton, Hennessy, etc. And they will trade at a premium relative to other retail brands, but consider the brands that they do own under their belt. So, under many market conditions, that company will perform well. Something like Lovesac, something like, Bath and Body Works, something like the other one, Kohl's, those will tend to have a bit of more struggle. But if they execute well, you could experience ridiculous rates of return. So pretty good rates of return. If you can acquire it when, the peak pessimism is in there. And that requires the investor to understand a lot about these businesses. So if we actually go back to, for example, BBWI. So BBWI, you can see here during the downtroddenness of the pandemic, we go down to 5 years. There was this moment in time when you had this massive explosion. And we're going to do an update on Crocs, for example. With Crocs, kind of similar story of sorts. And similar, company with regards to, it's a brand, it has stores, they sell shoes, they sell the Crocs shoes. So that will go into the update video. But, all of these together today kind of have this similar story behind them and something that you have to consider. So they appear to be cheap, a lot of them, except for, what was it, Bed Bath & Beyond. That one's the one that doesn't appear, that appears to be a more classic value trap. Maybe it's not a value trap because, it's not showing up that it's cheap. It's showing up that it's, really difficult rather and expensive. Something like Bath and Body Works does appear to be cheap, but what requires from here is further analysis on the health of the industry or the business, or where do you think it's going to go from here in terms of, are they going to gain market share? Is there more opportunities for them to upsell to clients? What else are they going to get into as a company? Is the CEO still Lex Wessner? I haven't paid attention to this guy in a long time. Because he had this whole scandal because, of some things he was probably involved in, but potentially, don't sue me, bro. But all in all, a lot of these companies, they appear cheap. Let me know down in the comments section which ones you guys are interested in. If I got to be honest, the one I'd be probably interested in the most is Bath and Body Works and probably Lovesac. Bath and Body Works and Lovesac over Kohl's. Even though Kohl's looks like it's crazy cheap, Kohl's is probably so cheap that maybe it would warrant like a speculative play. Remember that we did that with Foot Locker when Foot Locker went down so much, and we made a quick trade profit. We did the video on me buying it and then the video on me selling it, and those are all on the channel too. If you guys are curious and want to check that out, you can probably find it. Just look up the Foot Locker ones, and all in all, I want to know what you guys think down below. Which ones are your favorites, if any, or all of them are kind of to you. So that concludes this subscriber request video. We covered, decent amount of stocks. On that note, guys, thank you guys so much for watching, and I'll see you guys on the next one. Bye.